mean, I made a lot of posts about how quote unquote timing the markets very randomly distributed, and there's no obvious and easy way to do that. You can try to guess market psychology, but it's very touch and go. Even the best people I know at it are barely above random. So, sticking to one's fundamental instincts is, I think, a better game plan.
Well, most people who have run up a ton of money are, they've very quickly, they usually did it by accident, and they very shortly will be returning their money to the market. And it's at least smart of you to resist that. Take what you got, preserve it. And then if you are going to extend it very slowly and carefully. A really good trader honestly doesn't need more than 1 or 2% of his portfolio. 20 or 30% of his portfolio at risk. You shouldn't be ever putting your whole stack in. Now again, I don't always practice what I preach. Yeah, I've made mistakes that I've profited from for sure. Yeah, we should definitely get a charting book. I mean, there's so many people up double, triple digits this year, and they think they became Warren Buffett overnight. Yeah, I mean, just nobody's talking about price. So like when people talk about Open Door, they're like, well, this new CEO is really good. I'm like, yeah, I know. Oh, and they're addressing a big market. I'm like, yeah, of course. And then, housing is going to come back. I'm like, yeah, all of that stuff is good, but what's it worth? And they're like, oh, what? Yeah, like, the stock market is like going shopping, right? Okay. And here's this shirt, okay? You can draw a shirt. You go shopping, you see this nice shirt. Okay, and it's Armani. Okay, the A is for Armani. Okay, then you see this shirt, and it's Fruit of the Loom. Okay, F for fruit. Okay, the Armani shirt is much nicer because it also says Armani. And then the price of the Fruit of the Loom shirt is $15. The price of the Armani shirt is $10,000. So Armani shirt's pretty good. It's really great. Yeah, okay, great. And then you say, well, not only is this Armani shirt good, but I have good news for you. Kim Kardashian wore it yesterday. That's even better news. I can't believe how good this news is. Oh, guess what? It's about to be spring. You can wear this shirt in the spring more than you can wear it in the fall or the winter. So spring's coming up, bullish. And the Fruit of the Loom shirt, actually, maybe it's got this tiny hole in it, like it's almost imperceptible. There's little smidge there. And they say, you know what? We'll sell you this Fruit of the Loom shirt for $1. And you say, nah. The news isn't good there. It's got that smidge. No way. I want to buy the Armani shirt for $10,000. That's how you guys act. You were born that way. You'll always be that way. Yeah, I saw that road. That's top-E behavior, right? No, value is important all the time. Value is only important in a crisis. You want to accumulate valuable things over time. I don't know if Warren Buffett taught anybody anything, but... What bubble? 𝗥𝗏. 𝗥𝗏 is not a bubble. Nuclear's taking over. Chips aren't going to get more efficient. We're going to need nuclear energy everywhere. Everything's going to be glowing. Radioactive AI. That's why I'm not short 𝗥𝗏. I've avoided getting murdered on that.
Yeah, I think a lot of people have a hard time buying something after it's up, when obviously it has nothing to do with anything. This is the problem people had with when I raised the price of that drug from $1,350 to $700. They saw, 5,000%, that's crazy, but if you actually did the math of how much the drug cost, it was actually not that expensive relative to every other drug. It's kind of normal price. These percentages just play games with people's heads. It's natural, it's human, but you have to just take everything into account. 20 million market cap, even right now, 70 million market cap. You got an FDA approvable drug. I mean, come on. You have to throw away the anchoring bias that you have towards numbers and say, if I'm a guy at Pfizer or private equity and somebody says, I have a drug company to sell you, they don't ask, what's the stock price? They say, well, what's the asset? And I say, okay, what's it for? Sanfilippo, okay. I know Sanfilippo, it's, like 1,000 patients, right? And you can charge $500K each, so it's 500 million.
So I would pay 4 times sales. It's about 2 billion. So if I could buy that for 1, I would do that. And then they say, what's the price? Oh, it's only a 77 market cap. I'll buy that. I'll buy that all the way up to $1 billion. That's how you do finance. You don't start with the price and say, oh my gosh, the price has gone up. That's kind of not the right way to do it. That's a little bit foolish. Crazy stock bull. Is it even gonna ever get unhalted? Yeah, we did the same thing with 𝗣𝗡𝗢𝗡. When 𝗣𝗡𝗢𝗡 came out, we started buying the crap out of it at 50. We didn't care.
Somebody's asking about options flow, and I really can't say this enough that you should not be looking at options volume and trading flow for very much of anything. Yeah, personally, I don't know any great investors that are looking at time and sales and divining very much from it. Traders do it a little bit too, but only guys on the street where blocks cross on the street. Exactly, QW, they do whatever gets the deal done. When professionals look at stocks that need cash, we model in that the company raises capital. So yesterday, if you read my tweet, I said that I assume the company has 3 million shares outstanding when they had 750. After the offering now, they have 1.5 million. So I'm still assuming they're going to raise more money.
We're betting against them, that's fine, but there's no need for the bet to work out today versus tomorrow, right? I wish it were down instead of up or flat or whatever. I liked it when it was down a lot. I like it less that it's recovered. But, what are you going to do? You can only, like I was saying at the start of the stream, you can only just feel comfortable in certain things. I'm so confident in quantum, it doesn't stress me out because I know it's all a joke. And the joke will end at some point. It's the stuff where you are sitting there saying, well, what if the cassava drug works? Right? What if I'm wrong? What if Immune's drugs works or ATYR's drug works? That's when you're sweating bullets saying, I don't want to be in the short. What's going to happen if it comes out and it works, right? When you have confidence, you can say, look, whatever happens is going to happen, and I understand the continuum of possibilities. I'm comfortable with all of them. Like when we bought Sarepta, we said the FDA might pull the drug. They might get more deaths. This might happen, that might happen, and you're just comfortable with every piece of it. And then, you make your investment. And I'm happy that it turns out that they're not pulling the drug. There haven't been more deaths, but there easily could have been. And you'd have to live with the consequences. The consequences of your position sizing and your decision making. Try not to put yourself in a position where you have to be right. And then try not to put yourself in a position, especially where you have to be right by a certain day. That is insane, right? I used to do that. I used to trade when I was 19 and stuff like that. I used to trade huge amounts of options. And I'd get on a lucky streak and I'd have $500,000 or some crazy amount. For me, it was certainly crazy at 19. And then I'd blow it all because I had to be right by a certain date on a certain stock. And it's just, who can do that? Nobody can do that. Wall Street people don't do that. They use options relatively sparingly unless they're professional vol traders. And then they're taking very little risk. Options are meant to reduce risk, not to amplify it. And, if you want to play the game on hard mode, that's playing the game on hard mode. You're not going to get rich doing that. Nobody's made a fortune from zero to hero with options and kept it. The same crazy risk you took to make the money will be the same crazy risk that's going to take you out of the money. When you trade options, you have to ask yourself, why am I doing this instead of common stock? And if the answer is because the volatility is mispriced, well, I don't know. I don't trade volatility. It's not something I know a lot about or have a ton of experience about. Decide what you're good at. If you're good at picking stocks, then go pick some stocks. If you're good at trading vol, well, I hope you're a mathematician or something, because it's pretty complicated. And it's most people on the street don't do it the way you think they do it. At the end of the day, you just have to look at yourself in the mirror and say, am I a pathetic gambler? And if the answer is yes, stop doing whatever they're doing, because it's pathetic gambling, and you have to go get a real job, create some economic value. Like, trading a piece of paper around is not creating economic value for yourself or others. If you're extremely talented at investing, okay, well, that's different. But if you're extremely talented at investing, you don't need call options and put options throwing your whole account into risk every day. You know, if you're good at investing, you didn't need any of that. Options can be safer in some cases, depending on how much you size and what you do exactly. But if you're telling me buying 100% of your account in puts versus 1% of your account shorting the stock, the shorting the stock is a lot safer, because the 100% in puts can expire the day before the stock drops 90%. You would have been a hero, but you got the wrong strike, the wrong expiry. You know, so just sort of try to stay away from. You want high returns, but you don't want them to be too high. Because chances are, if the return is way too high for the trade, it's too good to be true, and you're probably just fooling yourself. You know, you want steady Eddie. You can't roll if you put all your capital in one trade, which, again, a lot of you guys do that. A lot of you guys just want the one big win, the one big fat win. But you know you're just going to do it again. You're going to want to do it again, and you're going to blow it all. No, Dion, I mean, I'm not sure. Of course you want high risk-adjusted returns, but if you think you're going to make 10x in your portfolio, you're fooling yourself. Or if you think you're going to do that consistently, yeah, I may do it one time, but there's a reason why doing that consistently is impossible, because you'd be the richest person in the world. Yeah, be scared, be cautious, avoid risk. I think those are all wise things. I don't know about waiting for a report. Well, my price target, what would be your price target for Cure in case of a buyout? Here, let's understand this from a linguistics perspective first. What would be your price target for Cure in case of a buyout conservatively? That is our question, right? Cure is not a cure for Huntington's, to be clear. It's a treatment. It's a potential treatment without exactly definitive control data, so it's speculative treatment. If a company were to be bought out, I mean, it doesn't make sense. What would your price target be? I guess what you're trying to ask is, do you think there is a drug company out there willing to pay a premium right now for uniQure stock price? I don't think that's the right way to think about it. People ask me this all the time, and it doesn't make any sense. Drug companies don't just buy other companies for fun. They're doing it to get a deal, and there are many, many things that go into that. And very often, you may not get a deal. So if you're running uniQure, you don't assume somebody's going to come buy your company, nor do you look for somebody to do that. It'd be very foolish. If somebody does approach your company and says, hi, I'm from Takeda, I'm really interested in your data on Huntington's. Well, now if you're uniQure, you have to sit there and say, what does this person want? Are they wasting my time? They may be opportunistic, they may not be. Okay. Pfizer calls you as well. Now you might say, I got to hire an investment banker. I don't have the time to talk to all these people. I just do a data room and invite all these people to the data room. Merck wouldn't be interested. J&J wouldn't be interested. Roche kind of has a couple irons in the fire here, but Roche could be interested, for example. Bristol Myers, I don't think would be interested. Go down pharma here. Novo Nordisk, AbbVie, no. AstraZeneca, could be interested. Okay, Novartis, who knows? Maybe even Vertex, Sanofi. So you got maybe 7 realistic buyers for uniQure. 7 buyers for uniQure. And uniQure, Takeda approaches. uniQure says, all right, I'm going to hire Goldman Sachs. Goldman Sachs banker talks to all of them. Says, you want to be in the data room? 5 of them say yes. Let's just pick 5 at random. 𝗏 is as it came out to be spelled, but those are the initials for the trans, actually. The 5 companies that were contacted, and they said, yes, I'll go to the data room. And, all right, you know what, Elvis? I'm done with you. You want to insult me? Better things I do with my time to teach you Wall Street one-on-one.
Field, but you have to add a couple more. These are 6 lysosomal storage drugs, but they didn't include myozyme. They actually didn't include a bunch of them, but I don't mean to pick on these guys. But the market cap was 400, or I'm sorry, the average revenue of those 6 drugs was 400. I wouldn't even include the dud. So say 400 or 500. I mean, 400 or 500 peak sales for a rare disease drug is worth a lot. I mean, this is kind of shortchanging it. But you know, it's good to make a model and stick to the model. You don't have to pump the numbers because you feel like it. You know, make the best model you can. And the one I made spits out, you know, almost $1,000 a share. In my history in biopharma, I mean, it's pretty reasonable. Now, of course, you know, the stock goes up a lot, and you say, I missed it, but that's, like I said, cover up the share price. Just do the model and say, what will this drug sell? This is really easy. You know, this is not like programming. Programming's hard. Millions of people program. Doing this thing takes 10 minutes. You know, you do the years, how many people have the disease, what's the price, how much will it sell, how many people will take it. You know, that's it. You know, there's not much, you know, there's really not much else to do. You do this discounted formula, NPV, you know, and you sort of, the last thing you do when you do these forecasts though is you don't want to, a lot of these you can do in your head, by the way, but I recommend doing it on paper. But the only cardinal sin of forecasting is when you try to fit the numbers to the situation you want. And that's kind of the time when everything goes. You don't want to do that. As long as you make an honest effort to do the forecast and accept the results however which way they come, then you know you can believe in the number. And there's still open questions, like if you have, somebody asked earlier, if you have Sanfilippo and you're 12 years old, should you take this drug? And I think the answer is yes. I mean, I don't think you want to not take the one drug that could save your life. At the same time, if you're profoundly sick, you know, should the healthcare system be paying for your medicine? Typically, the answer is, you know, they don't care. They'll pay because it's only one patient here and there. It's not millions of diabetes patients, for example. I don't know. You know, that's kind of.
So Carol Kens asked, why do you box with the trends that are going long? So I'm not, you know, I'm a contrarian investor. I'm a short seller. I have longs, I have shorts. Some of my longs have 2x to 8x this year so far. So I'm pretty happy with those, but I short sell the companies, the stocks that I think are worthless, fraudulent, scams, etc. I don't short stocks of good companies, very rarely. And if I do, I'm there for just a few minutes. Usually, but this is how I invest. You know, not everybody invests that way. So some people would be, you know, find it quite perplexing how, you know, somebody invests this method. Now everyone has a lot of different methods. You know, they're fighting methods that are different. But, you know, a Taekwondo master and, you know, I don't know, a Brazilian Jiu-Jitsu master and a boxing master are all different types of fighters. So they would find it weird, amusing, funny almost how another boxer does it. The boxer would say, why don't you guys just punch? Just punch. Punching is good. You knock a guy out in one punch. And the Taekwondo guy says, no, you need to kick. It's all about kicking. So you got to decide, you know, are you a boxer? Are you a Taekwondo specialist? Are you a Brazilian Jiu-Jitsu? It's up to you. You might go with the trends. You might say, I'm never going to take a loss in my portfolio. I cut all my losses immediately. And other fighters say, you know, that's not how I fight. Okay, Syndax and Kura, thank you for that. I will add those to my list because there's a whole bunch of binaries. We got Biohaven,